Hello everyone, this is professional real estate investor David Campbell, and it is my pleasure to welcome you to today's webinar, Investing Your Self-Directed IRA When Your Income is High and Your Balance is Low. And for a lot of people this is a big challenge because they save and save and save towards getting enough money to buy a property, but there's a lot of challenges with buying a property in that you need a large down payment. Especially when you're buying in your IRA, traditionally you can only get 50% financing, and there's all kinds of challenges in owning real estate in your IRA, and those challenges are even bigger when your balance is small. So we're going to talk about a lot of solutions today on how to do that, and we're going to meet my special guest, Karen Hall from UDirect IRA a little bit later today. So just a little bit about myself. I think most people on the call know who I am, but just a little introduction. I started out teaching high school band in Southern California. Real estate seemed like a great thing to get into about 12 years ago. Became a multimillionaire through the vehicle of real estate. I left my job teaching. I started a real estate development company. In the last 12 years, I've had over $800 million of real estate transaction experience. Very fortunate to be a regular contributor to the Real Estate Guys radio show, which is the #1 most downloaded show about real estate on iTunes. Well over 1.5 million downloads. And also fortunate to be on the faculty with Robert Kiyosaki and several of his Rich Dad advisors at the upcoming Real Estate Summit at Sea. But really at the end of the day, I am just a regular guy. I have a 3-year-old son and a wonderful family, and really just trying to make sure that I'm balancing time and money. And for a lot of people, that's their struggle. How do they balance? How much time and effort and resources do I put towards making a fortune versus how much time do I allocate towards my family? And there's a great webinar on my website at hasslefreecashflowinvesting.com, a great video with a good friend of mine, Ken Gain, where we talk about creating prosperity and happiness and really talking about this balance. So even though I've done a tremendous amount of real estate, just a regular guy, put my pants on one leg at a time, and really encourage all of you to reach out and get to know me, because I would really like to get to know you. So today's agenda, learning about when your IRA should own positive cash flow properties and when positive cash flow sucks. IRA profits for high-income earners when you've got a very small IRA balance. We're going to talk about a concept that I call deferred down payment, and we're going to learn about the benefits and pitfalls of using high financing or high leverage inside your IRA, and we're going to learn from Karen Hall how easy it is to use a self-directed IRA to own real estate. So it's my pleasure to introduce a wonderful, wonderful woman, the president of UDirect IRA Services from Southern California, a wonderful woman, the smartest person I've ever spoken to on the subject of self-directed IRAs. Let's welcome to our webinar, Karen Hall.
Hey, David, thanks so much. I appreciate that introduction. And thanks for letting me be the guest today. I've got a lot of pointers and a lot of information to cover.
Fantastic. Well, let's get going. So beginning with the end in mind, this webinar is not a sales pitch. There is nothing for sale. Karen and I have a lot of great ideas for you, but we are not licensed tax, legal, or investment advisors. And I strongly encourage you to take any of these ideas to your team that are licensed and appropriately qualified to advise you on these ideas, because your situation is unique. So what this webinar is about is introducing you to people. Karen and I are looking forward to getting to know you, and hopefully you would like to get to know us. We'd like to share some ideas with you that we think could really help the most number of people. In doing lots of investor strategy consultations, I come across a lot of similarities where people have the same challenges. And so instead of counseling people one-on-one, we put together group education moments like this so that we can get your macro questions answered, and then we can follow up with you one-on-one based on your unique situation. And also some opportunities on how to take this education and potentially turn it into action. We aren't going to talk about specific investments. That's really up to you. I own a home building company. We do sell real estate, and I do have a real estate syndication company that we aggregate groups of investors to go buy commercial properties. We aren't going to talk about that today, but if that is something of interest to you, look forward to following up with you one-on-one. One of the maxims that I like to say is stress is when your expectations don't match your reality. If you're expecting these beautiful gourmet cupcakes and what you get is the picture down below, that's a stressful situation for you. If you're expecting the cupcakes down below and you get them, well, then you're very happy. So it isn't the actual cupcake that gives you satisfaction. It's is your reality meeting your expectation? And the same thing is true with real estate. I like to say that stress or distress is not created by a property. It's created by the owner's relationship to a property. And so if you are in the haunted house business, this property right here is probably the best thing you've ever seen. This is a great opportunity for you. If you are in the single-family home rental business or luxury rental, this house probably would be potentially stressful to you. And there's a lot of things that when we're talking about investing, it isn't really about the property. It's about your relationship to the property. And so when we're setting our clients up for success, really helping them to get an alignment of these resources that you see. And oftentimes when I get on the phone with a client, it's because they have some type of a stressful event. The stress is what is the catalyst that makes the phone ring. And very often it's because they have mismatched expectations or mismatched resources, or their team, there's something that is not in alignment. And so the thing that they are hoping to get, there's a breakdown in the strategy that we're using. And so today is about some potential paradigm breakers in getting you to get an alignment of expectations, and so that you get what it is that you're looking for. Sometimes that means adjusting your strategy and tactics or your time expectation. Sometimes it means adjusting your actual expectations. This is a slide that I use a lot, and when you're working with the typical IRA and your typical financial planner, they're only working with that above-the-line resource, which is cash. When you are a creative real estate investor, and this is why people gravitate towards real estate, is you can supercharge the return, the above-the-line return, by using those below-the-line resources. And so when you go to your financial planner and you write them a check, the only resource they can work with is cash, because you're probably not running Google and you're probably not running Microsoft or any of the other stocks that your IRA might own. When you are self-directing your IRA, you get to leverage all of these below-the-line resources, and Karin's going to talk about some of the caveats to make sure that you're not disqualifying your IRA tax-deferred status. But it's possible in using a self-directed IRA to use those above-the-line resources and the below-line resources to generate high returns. One of the reasons I gravitate towards real estate in this market is that mainstream investment activities are not an option. Bonds and CDs are not outpacing inflation. The stock market is very risky. Robert Kiyosaki has a book predicting a very large stock market crash because of the baby boomers are taking money out of the market, while at the same time young people are not investing in the market. And we have a risk of hyperinflation, which means that if you're a saver, you're probably not going to outpace inflation. The first paradigm that I'm potentially going to break for you is the idea of cash flowing real estate. And my whole brand is hassle-free cash flow investing, so this is kind of sacrilegious for the hassle-free cash flow guy to say that cash flow might not be the best choice for you in your IRA. But again, there's no absolute. It's like that haunted house picture. It's what's suitable for you and your situation, because your situation is going to determine whether cash flow is appropriate or not appropriate. So I'm going to wear both hats on this side of the equation, and you can kind of figure out which hat fits. So the first idea is cash flow in your IRA. If you are taking cash flow one general rule in the marketplace is the higher the cash flow, the lower the overall yield. And so if you're taking distributable cash flow, then your overall yield is lower. And there's a lot of reasons for that, and we can really follow up with that one-on-one if you're not sure why that is. The other is, anytime you invest and your investment brings you a profit, that profit has to go back into your IRA. Anytime money goes in and out of your IRA, you've got transaction expenses, both from the IRA custodian level as well as from the investment level. Every time you buy a property, that property has transaction costs associated with it. So oftentimes I see people, they buy a property and they're happy that it's producing $200 a month positive cash flow or $100 a month positive cash flow. And I ask them, that's great, but if that property was in your IRA and you're getting that $200 a month in your IRA, what do you do with that $200 a month in your self-directed IRA? Well, it's just hanging out there. I mean, really, what do you do with $200 in a self-directed IRA? If you're looking at focusing on real estate, probably not a whole lot you can do with $200. But if that $200 were plowed back into your property in a number of different ways, through higher leverage, through principal reduction, etc., you can potentially get higher returns. You can potentially lower some of your transaction expenses. Also, anytime money flows in and out of your IRA, you've got to make a decision, and that decision-making process takes your time, and your time is money. And so really just trying to decide is, if you are investing purely for cash flow, you might have to make more active management decisions than if you didn't have that cash flow, or you're going to have idle funds sitting in the cash flow. Another thing to consider is, when you're in the contribution mode to your IRA, as you're putting money into your IRA, the money that you're putting in on a monthly basis that comes from your paycheck, that is cash flow. That's cash flow coming from your paycheck into your IRA. And so why should your IRA need more influx of cash flow from your investments? The flip side is, well, I'm going to put on the different hat and say IRA cash flow rocks, because it isn't right or wrong, it's just what's suitable for you. If you're in the part of your life where you're taking distributions from your IRA, you're in a position where you want your IRA to pay you on a monthly basis, then you certainly want that cash flow coming in. Or if you're just taking a more conservative approach to investing and you don't like the leverage involved with real estate, and you decide to buy properties free and clear, well, then that's better than bonds and CDs. I mean, you're still going to be able to get better cash flow or better returns than other potential opportunities. The other is, maybe you have a negative cash flow property in your portfolio, and you have a positive cash flow property in your IRA, and you're using the cash flow from one property to negate against the other. That could be a great option. The other is, if you're looking at buying a property with insane amounts of cash flow, and you're a high income earner and you've got a high personal tax rate, then maybe it makes sense for that income to happen inside your IRA instead of personally. That's especially true if your depreciation in the property, your depreciable basis in the property, is low, and so you don't have that ordinary tax shelter that would come from owning real estate outside your IRA. If you've got a low depreciation basis, or your depreciation offset is small relative to your income, then your property could be producing ordinary income to you, and that's where putting the cash flow in your IRA might make more sense. Karin, do you want to talk about cash flow in your IRA and any best practices that you see your clients implementing?
One of the things that the real estate investors really like is they really like to have that cash flow in there in case their real estate has any expenses. So that's one of the things that I noticed. So it's good to leave a little bit of a cash reserve in there. But of course, like you said so succinctly, that if somebody is in retirement mode and looking to live off the funds in the IRA, what's really great is, say, for example, you have a house and you buy it and then you sell it and you make a large return. Well, you can have that entire return be tax deferred until you actually need it. So you don't have to pay tax on the entire return. You just take it out as you need it, and so that can be a huge advantage.
When a lot of people are talking about real estate, they say, I want monthly cash flow. At the end of the month, I want money left over as a profit. And then when they are really, having a cocktail and talking around, with their friends and say, hey, I bought a property for 100 and I sold it for 200. Well, that isn't cash flow at all. That's capital gains. And those capital gains are what most people that's where most people make their wealth in real estate. Even Robert Kiyosaki, who really is the master educator on cash flow, when he talks, you'll hear him say, well, I bought a property for X million and I sold it for twice as much. Well, that isn't cash flow. That's capital gains. You made a big profit because, and there's cash flow is important for a lot of reasons, but cash flow isn't always the reason that people invest. And so I want to just kind of create a paradigm challenge for you to focus on where are you and what's your relationship to properties and your particular need for cash flow. One of the other paradigms is people think that if I'm getting high cash flow that I've lowered my risk. And I really want to break that paradigm because monthly cash flow, high monthly cash flow, does not necessarily correspond with a lower risk. And there are times when it does, and there's times when it doesn't. For example, you'll see large institutions buy properties, the brand new construction, very sexy apartment buildings at low cap rates. I mean, I was just reading about in the Multifamily Executive magazine that I subscribe to, there was an apartment building in Phoenix that sold for $33 million, and it sold at a 4.5 cap rate. And I think, oh my goodness, who would buy such a low cap rate property? Well, this is an A-class brand new construction property, and this particular fund, their goal wasn't cash flow. It was they wanted to have a brand new asset. And because of this positioning in the marketplace, they perceived that that was a lower risk than buying a beat-up old property that had a higher cap rate, because there's a certain risk with owning new, right? I mean, there's less risk because it's new and you don't have as much deferred maintenance and your cash flow might be more predictable, versus if it's old and beat up, your cap rate might be higher, your initial cash flow might be great, but what happens if you have a large capital expenditure like your boiler breaks, or you get roof leakage or something that's the higher cash flow that's associated with those C-class properties might not necessarily be a risk. And so what I want my clients to really think about is, do you need cash flow or do you not need cash flow? Because some of the more institution-grade, safest investments actually don't produce cash flow. And some of the more higher risk, more ghetto properties or C-class properties, or investing in alternative type non-investment grade asset types, they produce great cash flow. And so, just breaking that paradigm, if you don't need cash flow, take it out of your risk analysis because it doesn't really belong in risk reward. Of course, you want to use cash flow in your analysis of how much debt do I use, how much reserves do I have. Those are very important parts in determining your risk reward, but that isn't necessarily in asset selection. That's how your relationship to the property. So the cash flow is determining what property type, but then when you're determining your debt and your investment strategy, that's when cash flow becomes more important in your relationship to the property. So something that I call a deferred down payment strategy. Here's our friend from Popeye. I would gladly pay you Tuesday for a hamburger today. Why would you use a deferred down payment strategy? And a deferred down payment strategy is different than negative cash flow. And this is a concept that is a unique paradigm shift for some people, because you can have a property that is negative cash flow and it's just a bad investment, or you can have a property that's negative cash flow and still be profitable. And we'll talk about that over the next couple minutes. So deferred down payment is, what if you don't have a down payment? There's a lot of people starting out, they just don't have any money. When I started out as a high school band director, that was me. I didn't have any money. And so how could I go put a big down payment on a property when I didn't have one? And then, what if you don't need the cash flow, but the seller does? This is an interesting paradigm. I see people right now where the seller is at their point in life where they want monthly cash flow, but as a buyer, you say, I don't need monthly cash flow. I'm buying this for my IRA. I don't need a profit on this deal for 20, maybe 30 years. So I'm willing to delay my profit, but the seller needs instant gratification. That's an opportunity for you to potentially work out a deal with the seller to buy a property with no money down or low money down and give the seller the cash flow that they need. You can buy their equity out over a period of time. And also times the deferred down payment strategy is a great way to enhance returns. For example, I love taking very simple investment grade properties that you would normally see a REIT buy, and they're not very sexy, but they're very, very secure, in national credit tenants with high credit and long leases and low cap rates. All of those things that people say, yeah, that's great, but that's what my grandmother would invest in. I say, well, great, what if you could invest in that and get the sexy returns that you're looking for? Well, how do I do that? How can I own that really safe grandma property but get double-digit returns? And that comes to deal strategy and putting your deal structure together. Because if you use financing in a proper way, married with a good property, you can get high yields with low risk. And we'll talk about that as we go on. One of the core rules of hassle-free cash flow investing is investing with a cap rate higher than the interest rate. And here's an example. Let's say you're buying a property for $100,000, and that property produces $7,000 of net operating income. The result is a 7 cap rate. If you didn't understand what I just said, that's fine. Please go to my website, hasslefreecashflowinvesting.com. Go to the videos section, and there's a series of training videos on real estate math. So if you're not sure what net operating income is or how to calculate it, you're not sure how to calculate cap rate, you're not alone. Go to the video section of my website, and there's some free training videos on understanding real estate math. So now you've got a 7 cap, and you're able to borrow money at 5%. So you fulfilled that rule where your cap rate of 7 is higher than your interest rate of 5, so that we're happy. How much money do you want to borrow at 5% if you can invest it at 7%? The answer is all of it, as much as you can get. Because if you borrowed at 5 and you invested at 7, you're making a profit. You're making a profit on the bank's money. So in this particular situation, I borrowed the money at $5,000 a year, and I'm earning $7,000 a year, and I'm making a $2,000 profit. Well, what about amortization? What do you do because profit isn't necessarily cash flow? Because if I can borrow the money at 5% and I'm making a $5,000 payment, interest payment, and I'm getting $7,000 in net operating income, I've got a profit. But what if my amortization, is less than $2,000 a month, then I'm positive cash flow. If my amortization is greater than $2,000 a month, then I'm negative cash flow. And this is a slide I'm going to talk about just until it sinks in. Remember, we're working with a $2,000 a year profit. It's a profit. You borrowed at 5, you invested at 7, you have a profit. But if your amortization is greater than $2,000, your negative cash flow, is that a good deal? I don't know. Well, it depends on you, right? You're profitable and positive cash flow. That might be good for you if you need to spend the money. If you're profitable and negative cash flow, that still might be a great deal for you because you have the ability to feed the property. And what that means is you've got an amortization schedule that's more aggressive. Your loan is going to be paid off a lot quicker. So when we're looking at cash flow isn't really the metric that's important to me because it's very possible that you could have a positive cash flow property but have a cap rate that's lower than your interest rate, and that means that you're losing money on the bank financing. And so the more financing you have on the property, you're actually taking more and more of a loss. And so I separate in your mind cash flow from profitability. What we want is to be profitable. You don't necessarily need cash flow, especially if you've got a very small IRA balance that you're working with. And so if you've got a small IRA, it's unlikely that, one, you'll be able to get cash flow, and two, that cash flow is the thing that you're looking for. So where do you go with your small IRA? Group investments are a great option. You know, if you've only got a couple $1,000s in your IRA and you want to go buy large properties, then pool your resources with other investors to go buy that larger property. Leveraging future contributions. For example, what if you bought that $100,000 property with the 7 cap, but your amortization schedule was very aggressive such that you were negative cash flow? You might go to a seller and say, look, I'm going to buy your property and I'm going to pay you your equity over time, and let me give you instead of putting 20% down, why don't I put 1% down today, and I'll pay the balance of the down payment over 30 years. The seller's probably going to say no. That's not a deal that the seller is going to wait around for. But you might say, why don't I pay you your down payment over 5 years or 6 years or 10 years? And that aggressive payment of that down payment, that amortization of that seller finance debt might be profitable, but it could be negative cash flow. And if you're still contributing to your IRA, then that can make a lot of sense for you because you're making monthly contributions to your IRA. Your IRA turns around and makes that negative cash flow payment to the seller. And so if it's negative cash flow because you're unprofitable, bad. If you're negative cash flow because of a deferred down payment strategy, that could be very good for you. It depends on your situation. Also, consider getting high LTV financing. When you're working in an IRA, oftentimes the interest rate's higher, and so you have to say, what is an appropriate for me? There's no such thing as a good property or bad property. There's only appropriate or inappropriate. I mean, those shoes are a great example. Those shoes aren't good or bad. It's just, what's your situation? Are you wearing them to a cocktail party? Maybe. If you're going hiking, probably not. So really separate what's good and bad from what are you looking for and what's appropriate to your situation. Pitfalls of owning low money down inside your IRA. It's great to say, let's take your small IRA and leverage it up as big as possible, because the higher that leverage is, if you're positively leveraged, and let's just recap, I might be repeating myself too much, but I'm going to hit this nail home. Positive leverage is when your cap rate is higher than your interest rate. Negative leverage is when your cap rate is lower than your interest rate. And when you're positively leveraged, you want to borrow as much money as possible. When you're negatively leveraged, you are penalized for borrowing more money. The caveat of that is high leverage, even though it might be profitable, could still be negative cash flow, and there's some challenges with that. The first is the more leverage you have in your anytime you buy a property with leverage, you're increasing the probability of a cash call. I have an investor client of mine who's a very high income earner, and he likes buying properties that have a negative cash flow because he gets more benefit from the tax write-off and the depreciation. He wants to be very highly leveraged so that he can use all of that depreciation schedule on his balance sheet. He's a real estate professional, so he gets real estate professional status, and he can use all of that depreciation to offset some of his income. So for him, he doesn't want more cash flow, because that cash flow to him would result in a higher tax bill. What he wants is to be having as much leverage as he can to get that depreciation schedule higher so that he can offset and lower his tax bracket. Again, it's back to what's suitable for you. One of the biggest risks of negative cash flow, and again, negative cash flow but profitable, so we're thinking about being positively arbitraged or positively leveraged, even if you're making a profit because of that positive leverage, if you can't make your monthly cash flow obligation, your lender is going to foreclose and you lose the property and all of your equity. So you have to make a decision. Do you have sufficient cash reserves? Are you comfortable in your ability to continue contributing to your IRA on a regular basis so that when your IRA takes that negative cash flow to cover your deferred down payment, do you have enough income from your job to meet that? The third point, and Karin's going to really dig into that later, which is unrelated debt financed income tax, UDFI. And this is a really cool strategy that I learned recently, that IRAs and solo 401ks have different tax benefits associated with them in terms of their exposure to UDFI. So that's a cool thing that we'll share with you later. Also, you might run into maximum contribution limits where maybe your property is doing well and you're positively arbitraged, but the negative cash flow from that property, because of your deferred down payment strategy, your requirement for cash exceeds what you can put into your IRA. That could be a challenge. You might be in a situation where your property is negative cash flow and producing losses, but if that property is inside your IRA, then you won't be able to take those losses in the current year. Again, consult your tax advisor. And the higher leverage you have, generally more leverage means more depreciation, and you might be in a situation where that you aren't able to use that depreciation to offset ordinary income because that depreciation schedule's inside your IRA. Non-recourse financing. Karin's going to talk about your IRA can borrow money, but it must be non-recourse, and Karin will talk about that a little bit later. But when you borrow non-recourse money, lenders generally charge a higher rate of interest. And we want low rates of interest. We want to borrow low, invest high. So how do we get low interest rate non-recourse debt? Well, the simple answer is you can have the loan be recourse to get that low interest rate. It just can't be recourse to you. You'll have to find someone else willing to put their personal recourse on that loan to get the interest rate low. Sometimes that's through an investment partner. You and a partner put a deal together where you come up with the cash, they come up with the financing. A group investment where the general partner, such as myself, would sign on the financing, sign on the debt, and it's non-recourse to you. Maybe you can negotiate seller financing where the seller is willing to take non-recourse to give you non-recourse financing. You could do an installment sale, or you can get an investment-grade tenant where, for example, if your tenant is strong enough, the lender doesn't look to you as the guarantor. They look to the tenant. For example, one deal I'm working on is potentially leased to this estate, the state of Texas. And the signature of the state of Texas is strong enough that a lender would lend to me as the property owner because I have a lease to the state of Texas. And the lender doesn't need my signature to insure that loan because the tenant has insured that loan because they're a very, very strong tenant. The other idea is blended interest rates. Maybe you could go to a hard money lender or an IRA lender. There are lots of them out there. I think Karin has a section of her website listing various IRA lenders. That lender might charge you 7 or 8% interest rate on the money. And it's possible that you could get a first at 7 or 8%. Maybe the seller of the property might give you a second at 2, 3, or 4% interest rate. And then you blend those two together, and now you've got a very manageable interest rate. You're paying 8 on the first and maybe 2 on the second. And so when you figure out the math, you might actually be at a blended interest rate of 6 or 5%. And now you're good. You've got non-recourse financing, and it's at a low interest rate because of that blend of first and second. Oftentimes, the seller doesn't have the ability to lend you all of the money on the property. Maybe a seller has to pay off their lender, so you need to come up with 50 or 60% of the purchase price in cash. That could be from your lender and, a conventional lender, and maybe they have, 40% that they can lend back to you in a second, and then you can just let them carry their equity back to you, or a portion of their equity back to you at a low interest rate. So those are some great ideas on how to implement your IRA from a strategy standpoint. And so now I want to really invite Karin Hall to give us the tactics of how do we do it from a mechanical standpoint. Karin?
Thanks so much, David, and wow, what great information that was. I mean, it's really nice to think of these things from a different perspective. Very, very awesome information from you. Again, as David said, my name's Karin. It's Karin Hall. I'm president of UDirect IRA Services, and David kind of gave you the caveats before, but just to say that, we're not a fiduciary. We don't give tax and legal advice or investment advice, so that's why it's really great to have investment professionals ready to give you that kind of advice, and tax people and good attorneys when you're investing, because you need that kind of advice. What we help you do is truly self-direct the IRA, and that is our position. So let's go forward here. And the next slide would be to talk about the self-directed IRA itself and why we haven't heard about this. I mean, it seems that self-directed IRA, is this something new? I get asked that quite a bit. People wonder, why haven't I heard about this? Is this brand new? Well, no, it's not. You've been able to self-direct your IRA for about 36 years, so don't feel like this is some flash-in-the-pan idea. It's been around and tried and tested for a long time. Even if your attorney or your CPA isn't familiar with it, it doesn't mean that you can't do it, and we'll talk about where you can find those rules in just a moment. The difference between a typical IRA and a self-directed IRA is basically the asset that the plan owns. So a typical IRA can own stocks, bonds, and mutual funds. A self-directed IRA can go a step further and own any asset except life insurance and collectibles. The self-directed IRA can own the alternative assets, the assets that aren't correlated to the stock market. So rental property, notes, stocks and bonds, private stock, I should say. Maybe you've got a friend that's opening a company and they're selling shares of private stock and you want to buy in. Lots and lots of opportunities. By the way, precious metals are something people really like in IRAs as well. So losses, if your IRA does suffer a loss, it's not written off on your taxes, so that's something to keep in mind. Losses can't be replaced easily. You've got contribution limits, so just make sure before you invest that you do your due diligence, because again, a loss is going to hit pretty badly because you can't even write it off in your IRA. So again, do your due diligence. We've got some more information on our website about that. The IRS doesn't say what you can invest your IRA in. They only say what you can't invest it in, and this is what they say: life insurance contracts and collectibles. So your IRA is not going to buy someone else's life insurance policy. Your IRA also isn't going to, say, for example, invest in a fine wine collection or an art collection. That is not permissible as an asset, but everything else is. I've had clients invest in mango trees in the Philippines, clients who invest in maybe, one guy bought tickets to the Super Bowl in his IRA. So basically he just had his IRA pay for the tickets. He sold them, I think, on eBay, and the profit went back into his Roth IRA, tax-free for life. So it's really anything except life insurance and collectibles. Now, if you are currently working for a company and you've got a 401k plan with them and you think, wow, this is great, I'm going to take my 401k money and self-direct it into this deal, well, chances are you will probably not be allowed to do that. What you have to do is wait until you leave the company, but you can go to the plan administrator and ask for what's called an in-service transfer. You're in service, you're still working there, and you just want to transfer the money to an IRA. Well, they may or may not allow you to do that, but it's worth asking, right? So again, if you're still working for the employer that gives you your 401k, probably won't be able to use that money to self-direct. Okay, then when it comes to the IRS guidelines for these IRA accounts, you can find them at irs.gov. That's their website, irs.gov. Look up Publication 590, because that's where it's going to discuss some of the rules, and we'll cover some rules right now. So basically, on Pub 590, it says you're not going to borrow money directly from your own IRA. You're not going to sell any property you personally own to the IRA. You don't use the IRA as security for a loan, and you don't use it to buy property for personal use, either present or future. Now, to go on with some of the other rules, it's really important to understand who's qualified and who's disqualified to your IRA when you're structuring a deal. So people who are disqualified, they are your lineal ascendants and descendants, like your parents and grandparents and their spouses, you and your spouse, your children, your grandchildren, and their spouses are all disallowed to your IRA. But the people who are allowed are the people who are out here to the sides, like your aunts and uncles, your cousins, your nieces and nephews, brothers and sisters. They're allowed. So your IRA could, for example, buy a house that your aunt owns, but your IRA could not buy a house that your mother owns. That's the difference. These are the IRS rules. If your IRA owns a property, say it owns a single-family home, your nephew could live in that home and rent it from your IRA and say go to college, but your son couldn't because your son is disallowed. So super important before you begin with a self-directed IRA to understand who's allowed and who's disallowed. Now, when it comes to prohibited transactions and really the rules, they fall pretty much into these three buckets, and then we'll move on. But number one is that neither you nor a disqualified person can have benefit from the IRA. That's present benefit, that's indirect benefit. So you have to be very, very careful that you're not benefiting from the IRA. For example, someone today who was talking to us wanted to be the listing agent or the buyer's agent on a deal that his IRA was buying. Well, he couldn't do that, and that would create some benefit. It would also apply to the third rule down here about providing services. So basically, you're not going to have any benefit. Another example of that is the appraiser that walked in the office and wanted to make a note. I said, well, that's great. He opened an IRA, very excited, and he wanted to lend the money to his sister-in-law. Well, that's fine because a sister-in-law is allowed. Then I said, well, when your sister-in-law borrows that money, what is she going to do with it? And he said, oh, well, don't worry about it. She's going to invest in my company. So the money would start in his IRA. Maybe it would pass through his sister-in-law, but it was going to end up back in his company. That would be benefit. That would be benefiting from his IRA. The IRS has something else called the indirect rule, where if you can't do it straight on, don't try to go through a third party or maybe an entity to try to do it. The indirect rule would get you there. All right, bullet point number 2 is that you can't buy, sell, or exchange property between the IRA, the plan, and someone who's disqualified. So your IRA, like I was mentioning before, won't be buying a house that your mother owns. Your IRA won't sell any assets, say, for example, to your son. It just doesn't work that way. That's a prohibited transaction. And the third bullet point is that you can't provide goods, services, or facilities to the plan, like that realtor who wanted to be the buyer's agent on a house that his IRA was buying. No, he would be providing services to the plan, whether he was paid or not. It's the services. For example, when your IRA owns a house, you don't go in there and paint the walls and put in the new hot water heater because they call that an over-contribution of sweat equity. You're not allowed to do that. Maybe, for example, you've got a house and the lawn needs to be mowed. Well, you certainly couldn't do it. And maybe you've got a son. You think, oh, I'll just send my son over there, let him do it. Well, he's disallowed, and so he couldn't do that. So if you've got a transaction and you want to understand, hey, can I do this? Is it allowed? Is it a prohibited transaction? Then that's when you can call us and we can help you sort it out. That's one of the great things that we do. When it comes to the structure of the IRA, this is important to understand that you and your IRA are separate entities. So, for example, when your IRA is buying a house, it's not your name on the contract. It's the custodian for the benefit of your IRA. That's what it looks like. And so then it's not you that signs the documentation. The custodian signs on your behalf. Then in the structure, there's you direct IRA services. We're your point of contact and the third-party administrator, and we help you all along and hold your hand throughout the whole process. And we have enlisted the services of a custodian to help our clients, and that is American Estate and Trust out of Nevada, and they hold the money and so forth. So now that we understand the structure of an IRA, let's talk about buying real estate with an IRA. Pros and cons, right? So the upside is that any capital gain, any positive cash flow, whether you want to call cash flow a monthly amount that you get or you want to call cash flow the gains from a sale, anything that comes into your IRA is tax-free or tax-deferred, and that is great because you're not going to pay capital gains on that money. There's no time limit on holding the property. That's wonderful to know. And as David was mentioning, the IRA can borrow money, and you can leverage your investment. Also, potential to earn a larger rate of return because, say, for example, you do buy a house for $100,000, you sell it for $200,000. That entire $200,000 comes back into your IRA, and there's no tax. So the entire $200,000 can go back out into the next deal, and therefore it lets you compound your investment even more quickly. Now, the downside to buying real estate with an IRA is that you don't get the same tax advantages of owning real estate that you do when you own real estate outside the IRA. You're not going to be writing off depreciation. You're not going to take a deduction for capital losses or anything like that. You're not going to have those tax advantages. Or say, for example, your IRA owns a house that's in Hawaii. And you say, well, this is great. I'm going to fly to Hawaii, and I'm going to write it off because my IRA owns a house there. Well, that wouldn't work, and check with your tax person, but you're not going to be taking any tax benefit for a property that your IRA owns. So again, I think one of the best pros about buying real estate with your IRA is that this is where the money is. It's just so hard to get a loan, isn't it, on a property that is an investment property. So even if you're not having your IRA buy it, maybe you're having you want to have people partner with you on a deal. They can use their IRAs to partner with you on a deal because, again, this is where the money is. Or you can have someone else's IRA lend you money so that you can do a deal. Another great way to do this. So with that said, we're going to touch now upon IRA getting a loan and kind of elaborate and pick up where David left off about this. But as he indicated, a loan to an IRA has to be non-recourse. So what that means basically is that if there is default, the lender can only come against the subject property and not against you and not against any other asset in the IRA. And on default, the lender's not going to seize any of the plan assets or your personal assets. Now, with a non-recourse loan, there aren't a lot of lenders to choose from, and so that's something that you want to take into consideration. I do have a short list that I would be happy to share with you. It's not necessarily on our website, but I'd be very happy to email it to you. So they're also going to require a larger down payment. When I very first had this slide and started doing the presentation, the down payment was like 25 to 35%. It changed to 40 to 45%, and now maybe even 50 or 60%. It just depends on the risk that the lender is looking at. So, of course, rates are based on risk, and you would discuss that with a non-recourse lender. I'd be happy, again, to share that list with you.
On today's webinar specifically, it's how to buy property with when you have very small balance. And so it's easy to say, well, if you just put 40-45% down, and most people would be saying, if I'm going to buy a $100,000 property, I don't have $45,000 to put down, and if I'm going to even save up for it, maybe I'm only allowed to contribute $5,000 or $10,000 a year to my IRA, so it's going to take me 5 or 6 years to save up a 45% down payment, and by that time, this real estate party is going to be over. So how do I get advantage of today's market without putting 40-45% down? One strategy could be, hey, Karin, how about you go buy this property and you go use your own cash and your own credit and you go buy it all on your own. And now you own it. And Karin, why don't you put that property into an LLC? And now the property owns the LLC, and the debt is to you personally, Karin, and the LLC owns the property. And then I say, Karin, I've got a very small IRA balance. Maybe I've got $5,000. Would you sell me 10% ownership in your LLC that owns the property? And I'll be a 10% partner with you, and I'll use my IRA to buy 10% of your LLC. Now the debt to me is non-recourse, and we've been able to get very high loan-to-value financing, and because you've got good credit and good income, you can get the financing for maybe 5% or maybe better. And now I'm into a property with very low money down.
Yeah, you can absolutely do that, and people do that all the time. Another thing, too, is when I'm talking here about recourse lending, this kind of recourse lending, non-recourse lending, this is institutional. But another thing you could do is go find a private individual. It's not an IRS rule that says you have to have a large down payment. That's just how most institutional non-recourse lenders behave. But again, if you're going to get the money from an individual and they're willing to give you different terms, that's another way to think about it. One thing about the non-recourse loan is that when you're making one, you're not going to be making a personal guarantee to it. You're not going to personally guarantee, because that would be self-dealing. That would become a prohibited transaction. But if you have somebody else who is allowed to your IRA, then they could they could guarantee the loan for you, and that would be just fine. But again, when I'm talking here about non-recourse loans, I'm really talking about the institutional kind of a loan, and the list of non-recourse lenders I have are institutional lenders. But of course, you can always borrow non-recourse money from individuals and other IRAs, as a matter of fact. Now, when you do it, when your IRA does borrow this money, it can lead to this tax called UDFI that David talked about before. And here's how that works. Basically, UDFI works like this. It's any proceeds that are received because of leverage are subject to the tax. The tax is at the same rate as the estate tax rate, which is about 35% right now. So say, for example, your property was 50% leveraged. It's not that you don't want to do it, but because there are ways to minimize that tax and write it off, that's where you need a good tax professional. But if you're, say it's 50% leverage, 50% of the proceeds are going to be subject to that 35% tax. So before you have your IRA borrow money, it's good to pencil it out, begin with the end in mind, and take a look and see, all right, well, if my IRA owes this UDFI tax, that's fine, but can I minimize it enough that I'm still going to realize a good profit? And that is the question to ask before you have your IRA borrow money, whether it's, a lot or a little. But in the scenario that David just pointed out, where maybe I have my IRA buy into an LLC that owns a property, so I'm basically buying private stock in a company that owns real estate, well, I'm not going to have UDFI there unless that company itself borrows money, and then it's going to throw the UDFI back into my IRA. So just lots of different ways to structure things. Maybe your IRA could make a loan to the LLC, and the LLC could pay back a profit.
Yeah, UDFI is a really nasty thing for people who are using leverage, and real estate almost always people gravitate towards real estate because of the leverage, and if you're not using leverage, the returns aren't nearly as good. And so, for example, I'm working on a deal right now where the seller is going to carry back some financing for me, and we could call it debt, or what we worked out with the seller is instead of them loaning the money, they're going to become a shareholder in the company that owns the property, and we're going to have a stock purchase plan from them. And so at the end of the day, the seller's getting the cash flow that they're looking for, and instead of calling it debt, we called it they're going to be an equity participant in the company, and we're going to purchase their shares over time. So the seller get the net benefit they're looking for, and we're able to, through proper tax counsel, because we are bringing our tax counsel in at the front end, we have our legal counsel in at the front end, and structuring a deal to avoid the UDFI and still get the leverage that we're looking for. Because in this case, we're looking for using other people's money. Just instead of calling it debt, we call it equity with an installment sale on the equity, and it's net the same to me, and it's better for from a tax perspective.
Investors are always coming up with really creative ways to do things, and that's great.
Yeah.
So there's another kind of tax that an IRA can possibly be subject to, and I haven't heard you talk about this at all, David, but I'll just touch on it briefly, and that's called UBIT, Unrelated Business Income Tax. That's a different kind of tax, although it's the same rate and so forth, and you can find it in the same IRS publication. But UBIT is when the IRA is running a business. So I haven't heard you touch on anything that would hint me to think that anything you've said would trigger UBIT, but maybe somebody is fixing and flipping properties with their IRA. Their IRA buys a house, you get it fixed and flipped by hiring third-party vendors, and you keep doing this. Well, the IRS is going to say if your IRA is doing this, that you may be running a business if you're doing more than, say, 3 a year. It's not hard and fast. It's really subject to interpretation. But so if you're perceived to be running a business in your IRA, you could also be subject to this tax. So what I recommend is, if this is something that concerns you or interests you, to go again to the IRS website, irs.gov, and look up Publication 598, where you can read more about it. And these kinds of taxes, the UDFI and the UBIT, they're reported by your tax person on a Form 990T. So there you go. That's something that you would file with your income tax return. So when it comes to self-directing the process, or I should say actually buying real estate with an IRA, it's so important to first open and fund a self-directed IRA before you go shopping for a property. And this is something that occurs in our office on almost a daily basis, where someone calls and they're so excited because they found a property they want to buy, but they haven't opened their IRA yet. There's no money in it, and they need to have an earnest money deposit. Well, we talked about prohibited transactions, and you need to make sure there's no self-dealing or present benefit, that kind of thing. So if your IRA is open and funded, then shop for a property. Remember, of course, that it's the IRA that's the buyer, so it's custodian for the benefit of the IRA. You give us a direction letter and then the offer to purchase. And then what we're going to do is wire the funds as you direct, right? You're going to tell us how you want that handled. We send the money to closing. You fund, you record, get your keys, your tenants move in, and then the tenants are going to make their check payable to the IRA, to the custodian for the benefit of the IRA. Now, another way to handle that is to maybe have a property manager and have the tenants make their check out to the property manager. That also works out really well. Now, if the IRA depletes its reserves, because before, David, you were talking about cash flow, and if you've got $200 in your IRA, what are you going to do with it? If your IRA does own real estate, it's one of those assets that seems to have a lot of expenses. So I recommend that you leave a cushion in your IRA to cover expenses. And then if you've got more than a cushion, go ahead and reinvest that. That's a great idea, because obviously the point is to have the best ROI possible. But if the IRA does deplete its reserves, you can do a few things. You could write a check and make an annual contribution. You could liquidate other assets in the self-directed IRA, like maybe some gold bullion. Maybe you've got gold in a house. You could sell the gold and use the proceeds, to go make that, say it's a property tax bill, to pay the tax bill. Maybe you've got another account, like maybe a Charles Schwab account that's invested in the stock market across the street. You could liquidate that, transfer the money from that IRA account into your self-directed IRA, and use that to make up from the shortfall. You could also bring on a partner, as long as they're not disqualified. And here is where the IRA could get a loan. This would definitely not be an institutional non-recourse loan. This would be from a private individual, but the IRA could borrow the money to make up the shortfall. And if all else this fails, then the IRA could just sell the asset, and then you'd be done. But just to know that real estate is one of those special assets that does have a lot of expenses, and so a reserve is always a really good idea. There's another way of investing with your IRA, and that's called a checkbook IRA. And that is something that it's important to understand before you launch into it. I do have a link to a webinar that I did with an attorney, and I'd be happy to share that with you so that you understand this more fully. It's like kind of a class in a box, You can listen to it at your leisure. But basically it works like this. You have a self-directed IRA, and then the IRA purchases the shares of a newly formed LLC. So you have an attorney draw up the LLC, and your IRA buys the initial shares of that LLC. And basically what happens is then that we send the money from the IRA into the checking account of that LLC, and now you as the managing member have checkbook access and can invest. Now, of course, that checkbook IRA has to follow all the same rules as a regular IRA does for investing. So it's really important that you understand prohibited transactions, because when you are using your checkbook IRA to invest, you're not passing it through a filter like us. You're just going to make decisions on your own, and you want to make sure they're not prohibited transactions. So again, before you go with the checkbook IRA, listen to the classes I have, and become, be an informed and educated investor here, because like they say, with great power comes great responsibility. So we're going to help you understand how to use that tool. So with self-directed IRAs, it's really not just the IRA that you can use to invest. It's all these different kinds of plans. It's, even an inherited IRA, a Roth, a traditional, but also we offer the solo K, the individual K, and because they have a lot of bells and whistles, including the fact that a solo K is not subject to UDFI tax. Remember we talked about the tax on borrowed money? When your IRA borrows money, that solo K is the one entity that's not subject to that tax when it comes to IRAs. So other plans that you could self-direct would be a Coverdell. That's also called an education savings account, or ESA, and a health savings account, or HSA. That's also something that you could self-direct, very powerful vehicle. So just to know what the self-directed IRA is. If you have, say, a SEP IRA now, it could become a self-directed SEP. If you have a solo K right now, it can become a self-directed solo K. And the only difference is the assets that the plan can invest in. So the process to self-direct is a three-step process. It's open, fund, and invest. So you open the account, and then once it's open, then you want to put money in it, and you can do it in one of three ways: by annual contribution, just writing a check; by an IRA to IRA transfer; or by rolling over an employer plan, like a 403B or a 401K or something like that. And so once your account is open and the money's there, then you decide what you want to invest in, and then you direct your account into the assets that you like. And that's how the whole process works. So, David, I'll hand things back over to you. And again, thank you so much for letting me talk about self-directed IRAs and how they work. It's my passion, and I just love every time I have the opportunity to talk about it. Always happy to answer questions. And thanks. I see that I've got my my email addresses right there. So thank you.
I want to really thank everyone for being on our webinar today. You can find a lot of great educational resources at udirectira.com, as well as my website, hassle-free-cashflow-investing.com. Really encourage everyone to reach out to Karin and myself individually if you have questions, or if you just like the opportunity to get to know more like-minded individuals who have a lot of investing and IRA knowledge. Really look forward to speaking with you, and you all have a great day.